Look, my reaction was very similar to yours, undeniably hawkish. I think the market, has decided they're going to listen, which is why the equity markets, as you've been talking about, came off quite a bit. And importantly, he left three lessons at the very end. One is that the Fed, the central bank, is responsible for inflation. Two, that well-contained inflation expectations are not a cause for complacency because they might change at any moment. And the third thing he said that struck me was that they intend to stick with it. So lesson very clear, a resolute Fed chairman today here in Jackson Hole.
Oh, boy, you walked right into my follow-up question was on that exact point of the nature of how resolute Chairman Powell sounded today when he mentioned the pain for households and to some businesses. Steve Leisman, our senior economics reporter, of course, at that very moment flagged it. Did we not think that he was going to be as resolute as he sounded today? Why the disconnect between what happened today there and what I'm witnessing here at the stock exchange?
I'm not 100% certain because I was not particularly surprised that he was resolute. He certainly talked about the word pain. He said that there was going to be a long period of sub-trend growth. He also talked about having to keep rates higher for longer. None of those things were a surprise to me, or I think to many other listeners. I think what's really going on here is that the market themselves have gotten excited about the possibility of, a hump, moving up a bit and then coming down sometime next year. And I think today he took that off the table, and I think that was the point of disconnect, not intending to signal any sense of a cut anytime next year.
Yeah, I mean, he invoked, as I said, Mr. Volcker today, not by accident, I would assume. And by the way, as you know better than me and better than most, Volcker raised rates for a long time. We have just essentially started on this path of this new regime. And it seems like the market is so hasty to think that Chairman Powell is going to reverse course when he is clearly citing, if not using, the Volcker model as he figures out how to break inflation, as the former Fed chairman did himself.
Look, I think you raise a good point. By definition, nothing in that speech was accidental. It was a well-scripted speech. He read it word for word, so not an accident that he invoked Paul Volcker's name. I think we have to recognize that the current situation is not as dire as the one that Volcker confronted, in part because inflation expectations are currently reasonably well anchored. But importantly, Chairman Powell wants to make sure, as he says now, that paying now is far less than paying if we delay. And so he's been clear there will be pain, but I think he sees this as a path towards a much more sustainable economy. I think where the break is with the market, or was with the market, is the willingness that I think the Fed is clearly signaling to see us go into a slowdown here. And I think the market had not expected the Fed to be so ready to talk about pain. The other thing that was interesting today was he did not talk about a path towards a soft landing. So something that came off the table was the soft landing or softish landing discussion and a path towards that. That was, in my mind, noticeably absent, along with the things that were noticeably there.
Mine as well, which is I wanted your reaction to that exact point, because it wasn't lost on a lot of people that he did not go there. And does that tell you that Chairman Powell, gosh, if not almost wanting a recession at this point to really break inflation, he's fully prepared that is likely to be the result?
I certainly would say that no one wants a recession. It is very painful. I think what he's observing is that if a slow economy, perhaps a short, mild recession, is the price to be paid for getting inflation out of the system now and maintaining credibility, he is willing to go there. So I wouldn't say wanting that, but I think he signaled clearly that a period of below trend growth, some pain for households, is more likely than not. And I think he's setting us up for what could be a harder landing than perhaps he had mentioned earlier on.
So let's finish up, if we could, sir, with trying to put the chairman's words into actual action. What happens in September? Your best guess. What would you argue for if you were in that room?
Well, let me talk about what happens between now and then. I think between now and September, it's clear that at least 50 basis points. I think they're going to want to keep 75 basis points as a real option. The week before the meeting, there will be new data, the freshest data on inflation. And I think they want the ability to go 75 in September if that's what the data call for. After that, I think perhaps another 50. So, I think they're going to try to be as front-loaded as they can, being data dependent. And so between now and the next meeting, 50 for sure, keep 75 as an option. When they get to the meeting, 75 very much on the table, and maybe even likely if the inflation data call for that. And then I think they want to also signal that they're not going to reverse course too quickly. So they want to keep this tightening of financial condition for as long as they possibly can.